single moving average tells you direction. A ribbon tells you conviction. Today, we dissect the moving average ribbon and Darrell Guppy's GMMA, which separates short-term traders from long-term investors visually, on one chart, in real time. By the end, you'll know exactly when the ribbon screams trend, when it whispers exhaustion, and when to ignore it entirely. A ribbon is simply a stack of moving averages with progressively longer lookbacks. Guppy's GMMA uses two groups. The short-term group is exponential moving averages of 3, 5, 8, 10, 12, and 15 periods, representing active traders. The long-term group is 30, 35, 40, 45, 50, and 60 period EMAs, representing investors. Exponentials are used because they weight recent price more heavily through a smoothing factor of 2 divided by the lookback plus 1. So the ribbon reacts but doesn't twitch. Think of the ribbon as a marching band. The short-term EMAs are the front row of drummers, quick and responsive. The long-term EMAs are the brass section in the back, heavier, slower, harder to turn. When the whole band marches in step, fanned out evenly, you have a healthy parade, a strong trend. When the drummers stop and turn around while the brass keeps marching, expect a collision, a pullback, or reversal. When everyone bunches together at an intersection, the band is about to choose a new direction. That's compression before a breakout. 4 geometries matter. First, fanned and parallel, strong trend, both groups sloping the same way with consistent spacing. Second, compression of the short group into the long group. Traders are losing conviction, expect a test. Third, the short group crossing through the long group, a potential trend change. Fourth, both groups compress together into a tight braid, equilibrium, energy building for a breakout. Width equals conviction. Crossings equal transitions. The classic GMMA long entry needs 3 confirmations. 1, the short-term group crosses up through the long-term group. 2, the long-term group itself begins sloping upward, not just sitting flat. 3, the short group fans out above the long group, showing traders are committed. Entering on the cross alone is amateur hour, you'll get chopped. Waiting for the fan filters most false signals at the cost of a few points of price. Exits come in stages. First warning, the short-term group compresses, fans narrow. Second warning, the short group crosses below itself, the fastest EMAs roll first. Action signal, the short group penetrates the long group from above. Full exit, the long group itself flattens and rolls over. Advanced traders scale out across these stages rather than waiting for the final break, because by the time the long group turns, you've given back a chunk of the trend. Here's a textbook setup. Price chops sideways while both ribbon groups braid tightly. Then a bullish candle pushes the short EMAs up through the long group. We don't enter yet. 2 bars later, the long group itself tilts upward and the short group fans wide. Entry triggers on the close of that confirmation bar. Stop goes below the lowest long group EMA, because if price closes back inside the long ribbon, the thesis is broken. Target is open-ended. Trail with the long group. Now Apple on the daily. Look for the periods where both ribbon groups fan out in parallel. Those are the holdable trends. Notice how every meaningful correction is preceded by short group compression while the long group keeps climbing. That's the rest before continuation. Contrast that with the moments where the short group fully penetrates and inverts the long group. Those mark the regime changes. Same rules, same signals, real money behavior. The ribbon lags. It is built from moving averages, so it will always confirm after the fact. In ranging markets, the two groups cross repeatedly and produce a sequence of losing trades, the classic whipsaw. On low-volume instruments, micro-gaps can flip the short group violently. And on very long timeframes, even the long group becomes too slow to be actionable. Know your market regime before you trust the ribbon. Ribbon divergence is subtle but powerful. Price makes a higher high, but the short group's fan is narrower than on the previous high. That tells you fewer participants are pushing, momentum is thinning. Pair this with a bearish RSI or MACD divergence, and you have a high-probability exhaustion read. The ribbon doesn't oscillate, so it can't show divergence on its own axis, but the width of the fan acts as a momentum proxy. The ribbon shines when combined with tools it doesn't duplicate. Pair it with ADX above 25 to confirm a trend exists before trusting crossovers. Add volume or OBV to verify that breakouts have participation. Use horizontal support and resistance to time entries on ribbon pullbacks. Avoid stacking it with another moving average system like MACD on the same time frame. You'll get correlated signals that feel like confirmation, but aren't. 3 pitfalls kill ribbon traders. 1. Trading every cross without waiting for the fan, you'll bleed and chop. 2. Using the default guppy values on every time frame, intraday charts often need tighter groups. 3. Treating the ribbon as a leading indicator. It isn't, it's a regime filter and a trailing stop, nothing more. Respect those limits and the ribbon becomes a workhorse. Tomorrow, pull up your 3 most traded symbols. Plot the GMMA. Mark every period where both groups fanned in parallel and ask whether you held those trends or fumbled them. Then mark the braids and ask whether you anticipated the breakout or got faded. The ribbon turns your screen into a story about who is in control, traders or investors. Use it as a regime filter, not a crystal ball. This is education, not financial advice. Trade your own plan. Manage your own risk. If this helped, do me a favor. Hit the like button, subscribe, and tap the bell so you don't miss the next one. See you in the next video.